Welcome to the Deep Dive. We're your guides today from Talk Tickers, and we're getting into the second quarter 2025 earnings call from Huntington Bank.
Yeah, we're here to break down their performance, look at the big strategic moves, and basically figure out what it all means going forward.
Exactly. Giving you the key takeaways without you having to sift through hours of calls.
And look, after digging through the numbers, it's pretty clear Huntington had a really standout quarter. They actually beat their own internal plans.
Okay, sets a strong tone right off the bat. So let's peel back that first layer, the headline numbers.
Right, so reported earnings per common share, that was 34 cents.
But the adjusted figures often tell more, right?
Absolutely. And their adjusted EPS showed really robust growth. 27% year over year.
27%. What does that jump really signal to you?
Well, it's not just a number, right? It shows they're effectively turning revenue into real value for shareholders. Profitable growth, basically, which is what you want to see in a bank.
Healthy core operations.
Exactly. And pair that with their return on tangible common equity, ROCE, hitting 16.1%. And get this, 17.6% on an adjusted basis.
Yeah.
That's a very efficient operation, generating strong returns.
Okay, so profitability, efficiency, definitely check marks there. What about the balance sheet? Growth.
Solid expansion. Average loan balances grew by $2.3 billion. That's 1.8% up from the prior quarter.
And deposits kept pace?
They did. Average deposits grew $1.8 billion, or 1.1% sequentially. It shows they're attracting business on both sides.
And this isn't just about getting bigger, is it? There's a quality aspect.
Definitely. It reflects strength in their core banking franchise. And capital-wise, their Common Equity Tier 1, CET1, ended the quarter at 10.5% reported. The adjusted CET1 was 9%.
Which is right at the lower bound of their target range.
Yeah, and hitting that isn't just about ticking a regulatory box. It signals they have the capacity, the financial strength for more loan growth and capital returns down the line without taking on too much risk.
Got it. And I saw tangible book value per share was up 16% year over year. It's pretty eye-catching.
Very significant. That's direct value accretion for shareholders.
Okay, but credit quality. Always the big question mark for banks. How did they fare?
Top-tier performance, really. Net charge-offs were just 20 basis points.
And that's down from the prior quarter?
Yeah, down 6 basis points. It speaks volumes about their underwriting and how they're managing the portfolio. Very healthy.
So strong credit, good growth. What about overall revenue?
Revenue saw an 8% year-over-year increase on a reported basis. And adjusted PPNR, that's pre-provision net revenue, grew an even more impressive 15% year-over-year.
15%, okay.
Yeah, you put all that together, you really see the momentum building across the business.
That's a strong snapshot. So let's dig deeper now. How did they achieve this? What were the strategic drivers? Management pointed to organic growth.
Right. Strong organic growth across loans, deposits, and fees. It wasn't just one thing. It was, earning asset growth, working together with an expanding net interest margin, plus those value-added fee services. It all contributes to what they call positive operating leverage.
Sounds like things are clicking.
Seems that way. Firing on all cylinders, as they say.
And speaking of strategic moves, the big one was the Veritex acquisition announcement. Expected to close Q4. This feels like more than just adding scale.
Oh, absolutely. This is about accelerating their Texas growth. They've been there since 2009 organically, but this puts them on a whole new level.
How so?
Well, Veritex gives them a real meaningful presence in Dallas, Fort Worth, Houston, big markets. It's a springboard. Plus, they get a great local team, deep relationships. Malcolm Holland's joining as Texas chairman.
So it fits their model, local relationships, broad capability.
Perfectly. It expands their product set in Texas significantly. Management seems really positive about the financial aspects for both sides, and they expect a smooth integration.
Okay, so what are the concrete opportunities they're targeting with Veritex?
They see a clear path to accelerating commercial lending and capital markets activities there. That should boost fee income, especially in areas like payments and wealth management.
And the branches. Veritex has branches.
Right, over 30 of them. That fast-tracks their ability to build out a Texas consumer banking presence. It's a pretty comprehensive strategy.
Makes sense. Let's tie that back to the balance sheet dynamics. Overall loans up almost 8% year over year. You mentioned new initiatives playing a big role.
Yeah, this is interesting. $900 million, or about 40% of the total loan growth, came from these new initiatives.
30%. Where specifically?
Mostly from Texas, the Carolinas, and some specialty areas like their financial institutions group and funds finance. It shows those targeted investments are paying off.
What about commercial real estate? Any concerns there?
Balances did decline, but importantly, the pace of decline is slowing down. And they mentioned originations are picking up, so it seems like they're managing through that cycle.
And on the other side, deposits. You said they were strong.
Yeah, really solid performance, driven by growing households and getting deeper relationships, more customers, seeing Huntington as their primary bank.
And pricing. Costs must be going up everywhere.
Well, here's the thing. Their deposit costs actually declined by 1 basis point sequentially.
Declined. How?
Disciplined pricing, they said. Even in this competitive environment, they seem confident about continued solid growth and stable costs, maybe even lower costs if rates start to fall.
That discipline is crucial. It flows right into net interest income, NII, and the net interest margin, NIM. How did those look?
Very strong. NII was up 2.9% sequentially and almost 12% year over year. That core earning power looks good.
And the margin itself, NI.
NIM was 3.11%. That's up 1 basis point from the prior quarter. Not a huge jump, but it benefited from less drag from their hedging program.
So they're managing the rate environment well.
It appears so. And they actually raised their expectations for the run rate NI for the full year 2025. Yeah. That shows confidence in their spread revenue. They've used strong deposit gathering to build up cash, optimize funding, and they've also reduced their asset sensitivity.
Meaning less vulnerable to rate swings.
Exactly. They're positioning themselves to be closer to neutral on that front.
Okay, beyond interest income, how are those fee businesses doing? Non-interest income was up 7% year over year on an adjusted basis.
Right, and that 7% reflects their strategy to diversify. The really interesting part is their key focus areas, payments, wealth, and capital markets. Collectively, those grew 11% year over year.
11%. And they make up a bigger piece of the pie now.
Yeah, 66% of the total fee income mix. That's a significant shift towards, more diverse revenue streams.
Can you give some specifics like payments?
Payments overall grew 7%, but commercial payments jumped 18%. That's driven by treasury management services and a new merchant acquiring model they've rolled out. Commercial card business looks strong, too.
And wealth management.
Also strong. Fees up 13% year over year. Supported by 12% growth in assets under management and advisory households, they brought in $1.8 billion in net new money.
Solid flows. What about capital markets?
Grew 15% year over year. That's linked to the strong commercial loan production, but also good performance in underwriting, syndications, and financial risk management products. High value stuff.
Okay, let's switch to the cost side. Expense management. JAP non-interest expense was in line with guidance.
It was. The increases they saw were mainly from incentive compensation, which, is tied to the fact that revenue and profit outlooks are higher and volumes are up. So kind of a good problem to have.
But they're still focused on efficiency.
Absolutely. Driving positive operating leverage is a key theme. They actually expect more positive operating leverage for 2025 now than they originally thought.
Even with investments. Their efficiency ratio is around 59%, stable.
Right. Management's view seems to be that investing in these new businesses and geographies now is crucial for profitable growth later. They believe it will lead to meaningful improvement in that efficiency ratio over time, even if it's stable right now.
Makes sense, investing for the future. Finally, let's touch on capital and credit again before we get to the outlook. You mentioned CET1 earlier.
Yeah, they're continuing to build their common equity tier 1. The goal is to push that adjusted CET1 ratio higher into their 9 to 10% target range.
And the benefit of that is?
It gives them firepower. Enables high return loan growth, supports regular capital distributions, dividends, buybacks, especially once the Veritex deal closes.
And credit quality remains strong.
Exceptionally strong, yes. The allowance for credit losses grew a bit to 1.86% of loans, which is prudent, but the forward-looking metrics look stable.
Any warning signs?
No.
Criticized assets?
Actually, the criticized asset ratio decreased to 3.82%, driven by a drop in the substandard category. There was a small uptick in non-performing assets, but they said that was due to a couple of specific one-off situations, not a broader trend. So still looking very clean overall.
Okay, so pulling it all together, strong Q2, strategic acquisition announced, solid fundamentals. What does this mean for the rest of 2025, their outlook?
They definitely updated their guidance upwards. For standalone Huntington, they raised the full-year loan growth range to 6 to 8%.
Reflecting that Q2 momentum.
Exactly. And deposit growth guidance also raised, now 4 to 6%. Again, emphasizing those primary relationships and pricing discipline.
And the big one, NII.
Yeah, this was significant. Full-year NII growth guidance jumped to 8 to 9%. That's up from 5 to 7% before. They're actually expecting record NII for the year.
Wow, okay. That's confidence. What about fees?
Fee income guidance held steady at 4 to 6% growth. They did mention strong advisory pipelines might push it towards the higher end of that range.
And expenses. Still expecting growth there.
Forecasted 5 to 6% growth, yeah. Driven by those incentive costs and higher volumes. But again, that focus on delivering positive operating leverage overall.
And credit. Any change to the charge-off outlook?
Yes. Given how strong the first half was, they actually lowered the full-year net charge-off guidance, now expecting 20 to 30 basis points, down from a wider range before.
That's a positive signal on loan health. Okay, what about the immediate next quarter, Q3? Any specific expectations?
Yeah, they gave some quarter-specific guidance, expecting about 1% sequential growth in average loans in Q3.
And deposit.
Expected to be roughly flat sequentially in Q3, with growth picking back up in Q4.
NII. After the strong Q2.
Anticipated to be relatively stable compared to Q2, maybe potentially a slight compression in the NIM for the quarter.
And fees and expenses for Q3.
Fee revenues projected around $550 million. Expenses estimated around $1.22 billion. That's about $20 million higher than Q2, but they flagged that increase is mostly due to marketing costs for a new brand campaign hitting the books in Q3.
Okay, and tax rate.
Second half tax rate expected around 19%.
So overall, the vibe from management seems pretty positive.
Definitely. They mentioned improving economic sentiment, a strong start to Q3. They really hammered home the durability of their business model, how they're delivering on guidance, and actually outpacing peers on organic growth.
And that position of strength allows for things like the Veritex deal.
Exactly. It drives the profit growth, but also gives them strategic options. And that sustained growth in tangible book value, the strong returns on capital, those are the core long-term value drivers they're focused on.
All right, let's shift gears for our not financial advice segment. We've heard about this robust Q2, the significantly raised NII guidance, the big Veritex acquisition accelerating Texas growth. How might someone construct, let's say, an audacious but plausible trade idea around this? Remember, folks, purely informational.
Okay, purely informational, audacious, but plausible. Well, given all that positive momentum and the potential long-term kicker from Veritex, one idea could center on the market maybe not fully pricing in that future earnings power yet.
So the idea being there's more upside than currently reflected.
Potentially, yes. The thesis would be that the combination of Veritex synergies kicking in, that continued discipline on deposit costs holding up, and the positive operating leverage compounding, especially as Texas becomes a bigger part of the pie, maybe isn't fully baked into the stock price.
So how would you structure a trade around that thesis? Again, hypothetically.
Hypothetically, if you believe that thesis, you might consider a long position in Huntington stock, Huntington. But to make it a bit more audacious, maybe a tactical options play. Perhaps looking at out-of-the-money call options, maybe targeting early 2026 expiration.
So giving time for the Veritex integration and growth story to play out and potentially be recognized by the market.
Exactly. It's a higher risk strategy, obviously, relying on the market eventually seeing and pricing in that accelerated growth and strategic execution. Definitely not advice, just a thought experiment based on the narrative.
Understood. A way to potentially leverage that positive outlook if one were so inclined and understood the risks. Okay, let's wrap this up.
Yeah, to recap, Huntington really delivered an exceptional second quarter. You saw leading growth in loans, deposits, and that key PPNR metric.
And that Veritex acquisition is clearly a major strategic pillar, positioning them for faster growth, particularly in a key market like Texas, all built on a strong foundation of disciplined credit and capital management.
Absolutely. And the raised full-year guidance across the board really underscores management's confidence. It speaks to the inherent strength they see in their business model right now.
As always, we encourage you to dig deeper into these results yourself and consider what they might mean for your own analysis. This discussion was purely for informational purposes and is definitely not financial advice.
Thanks for tuning into this deep dive on Huntington Bank.